This is the study session on portfolio management and the first reading, which is an overview. I sure hope you guys are as excited as I am about this study session. Look at some of these topics: portfolio risk and return, and it's a part 1 and a part 2. I wish there were parts 3 and 4 and 5. Risk management, portfolio planning and construction. This is going to be the most fun that you guys ever had. Let's look at the first LOS. Boy, this is really a basic one, really a general one. Describe the portfolio approach to investing. Here's the example that I always like to give. Here in the United States, we have these Powerballs. And a lot of times they go up to 100 million or 200 million or 500 million. I think a couple even have gotten to $1 billion. If you were to win this, what would be the first thing that you would do? Well, the first thing that you'd do is pay taxes, but then you'd have all this extra money and you'd buy a house and you'd buy a car and you'd buy a ping pong table and you'd buy all sorts of stuff. But you'd still have hundreds of millions left over that you couldn't possibly spend today. So what do you do with it? You start thinking, well, I need to worry about what's going to happen tomorrow and 10 years from now and 20 years from now. And so you start thinking about investments. And what are you going to do? Are you going to take all of that and invest in, let's say, a company like Procter & Gamble? Procter & Gamble makes all sorts of good stuff. They've been around for a long time. They're probably going to be around forever. And the answer to that is no. You're not going to put all of your eggs into the same basket. What we want to do is diversify. And that's an extremely important topic throughout portfolio management. So look at the colored eggs on the right side. We have things like gold. We have things like commodities. We have things like stocks and bonds, emerging market equity. Boy, all sorts of good stuff. And so what do we know? We know that diversification reduces risk. Everybody knows that. Everybody's little brother and little sister knows that diversification reduces risk. But what we're going to be required to do in this study session is to show it mathematically. And that's going to be lots of fun. All right, so the first thing here is to remember, of course, we're going to diversify across a broad range of asset classes. It's no longer sufficient just to diversify with cash and debt and equity. There's lots of other stuff that goes inside of those asset classes, but there are some additional asset classes that we're going to consider. All right, let's go ahead and talk about risk. When you're talking about investing in equity securities, academics for a really, really long time, professionals as well, have compartmentalized risk into two main categories. The first category I always like to think of as systematic risk. Systematic risk is measured as the variability in returns due to changes in economic factors. So when you think of systematic risk, I want you to think of the economic system, the system of the economy. So examples of these factors are things like interest rates, things like inflation, things like the size of the economy and whether it's growing or whether it's shrinking, who holds political leadership, threat of war, oil prices, anything that we talked about back in the macroeconomics reading. That's systematic risk. And what Eugene Fama taught us under the efficient markets hypothesis is that when any of those pieces of economic information changes, it's going to impact the price of a share of stock. Now, the other part of this is the risks that are specific or unique to each particular company. These factors are things like employee strikes, the branded product lines, supply chain, quality of the board of directors and the executive leadership, whether or not the firm is making something for pennies and selling it for dollars, all that stuff that we talk about in corporate finance. So I want you to think of this as systematic risk. And now this is how clever we are in the academic world. In the old days, we used to call it unsystematic risk, but now it's referred to as specific risk. It's the risk that is specific to each company. Now, here's the cool thing, is that when you invest in one stock, you're going to be exposed to both specific risks and systematic risks. But when you invest into a well-diversified portfolio of stocks, you're still going to remain exposed to systematic risk, but you have virtually eliminated the specific risks. Let me show you how that works. Here's a great picture. Notice on the horizontal axis, I have number of assets in the portfolio. And on the vertical axis, I have portfolio risk. Dare I remind you that we spent lots of good time talking about standard deviation as a measure of risk. Can I put standard deviation on that vertical axis? Now, notice is that a red line? Is that a maroon line? Is that a purple line? Whatever line that is, notice that it's downward sloping. So the first thing that you need to notice about this graph is that as we increase the number of assets in the portfolio, total portfolio risk declines. Now, let me give you some numbers that you probably don't need for the exam, but these are pretty good numbers to, if you can put these in the back of your head. All the way up at the intersection of the red line with the standard deviation. If you invest in one stock, the average standard deviation in the stock market is about 50%. Wow, imagine that. That's huge risk. Of course, we're not going to invest in one stock when we hit the lottery because standard deviation of individual stocks, it's just too high. And as we go down that curve, as we add stocks to the portfolio, as we get to the 10th and the 20th and the 50th, and we'll talk about how many you need for a diversified portfolio in a different video. But once we get all the way out there to a well-diversified portfolio, let's suppose we call that the S&P 500 index. That average standard deviation is in the high teens, 15, 17, 18%. So the cool thing about this graph is that it shows you the tremendous influence that diversification has on portfolio risk. Over 2/3 of the risk can be eliminated just by diversifying. Now, what I want you to do is I want you to compartmentalize this graph. Notice that at the bottom right, there are some arrows pointing up and down. This is called undiversifiable or systematic risk. Notice that that dotted line above it remains constant. That's a line. It's a fixed line that is parallel to the horizontal axis. What that means is that if you invest in one stock or 10 stocks or 100 stocks, you're going to have some level of systematic risk. But as you invest in the 10th and the 15th and the 20th, notice what happens to the red line. The red line falls, and that specific risk component then declines all the way. Now, the red line doesn't quite touch the dotted line there on the bottom right, but essentially it touches there, and we say that through diversification, you can virtually eliminate specific risk. So it's important. Describe this portfolio approach to investment. It's investing. It's important for you to distinguish between total risk, which is the height of the red line, versus systematic risk, which is fixed, and specific risk, which is declining. Next, LOS asks us to describe the different types of investors. And so essentially, we've got two groups of people. We have individual investors, and these individuals, they have short-term goals and they have long-term goals. And this is going to be summarized in the policy statement, whether the individual investor has a short-term goal, which might mean something that sounds like, boy, I've got several children that are aged, 10 and 12 and 14. They're going to be going to college in the next, 4 or 6 years. Boy, I need to plan for their education. As opposed to a long-term goal, which might sound like something that is related to retirement income. Now, individual investors, they have all different sorts of short-term goals and long-term goals. And this is going to be one of the challenge, especially when you get to level 3, of crafting a policy statement that is productive and timely and effective for each client. Now, back when I was working on my PhD, I found that academics have a word for individual investors, and this is really a broad word to use to describe them: atomistic, A-T-O-M, meaning that they're so small that you can't really see them, and so that they don't have too much of an impact on trading on the floor of the New York Stock Exchange. That's why I tell you that story, because the institutional investors are the big people. They are the big investors. The institutional investors manage hundreds of millions, billions of dollars of capital. And these are people like commercial banks and investment banks and insurance companies and mutual funds and hedge funds and pension funds. And so when individual investors put in a buy order, even a high net worth investor might say, oh, I'd like to buy, 20,000 shares or 50,000 shares, or maybe even in the extreme, 100,000 shares. But institutional investors are buying millions of shares, and they're doing this every day. So there are the investment companies. Those are the mutual funds, and then there's another group, these sovereign wealth funds. I wonder if you guys know that there are government-owned funds. There are government asset funds in which a natural resource like oil or gold is used to operate some kind of an objective inside of this wealth fund. And then there are pension funds as well. Well, let's go ahead and keep talking about pension funds. We mentioned the difference between defined contribution and defined benefit plans in a previous reading. These plans have similarities. Of course, they both plan for retirement, but they go about them a completely different way. And these are great questions about who assumes the risk and what is the future value and all that kind of good stuff. A defined contribution plan is one in which the employee makes contributions to the plan throughout his or her working life and directs those cash investments to a particular mutual fund or a particular financial asset. The important thing here is that the employee assumes the investment risk. I mean, this is what I have as a college professor. I have this kind of a plan. I put in a certain amount during every paycheck, and then my employer puts in a certain amount, and then I tell them where to put it. And so if on the day I retire, which, because I have lots and lots of children, I may never ever get to retire, but let's suppose I retire when I'm 90 years old, if I should be so lucky to live that long. And let's just suppose on that day the stock market crashes all the way down to zero, I'm going to have $0 worth of pension income. And so that's the important thing, that the employee assumes the investment risk under the DC plan. You guys know that we like to put up examples from the Nike financial statements. Here's an example from Nike pension fund in the Netherlands. And so we're told that you can accrue the pension 3 different ways. And there's a description of how the contributions are made. There's even a description of the formula that we will use. And so what does that bottom one say? Nike, you pay 4% of the pension base yourself. And then what you're going to do is you'll see this on your paycheck. How about a defined benefit pension plan? So the DC plan, we're going to define the contributions. I get to pick how much I want to contribute every week or every month. Defined benefit skips over all that. It skips over the time frame until we get to retirement date. And then it says, we guarantee that you will get a defined benefit. So that's a defined retirement income. And so if I had that where I teach, what my college would do is they would set aside a certain amount so that on the day I retire, when I'm 90, that the college would have enough to pay me. Now, the problem is that even though the college is required to make those payments, they may not make the full amount of the payment. They might not make any payments. And so on the day I retire, if the college has no money to pay me, they are still obligated, legally obligated. I mean, it's a legal contract. I promise to pay. And so imagine this crazy scenario where the college has to pay me my salary, but they don't have any money in their pension fund. So they're going to take tuition from current students and pay me during retirement, they won't have any left over to pay the current professors. And so here's the difference there. The employer bears all of the investment risk. Now, of course, the salary at retirement depends on a formula. It's probably based on average salary and the number of years worked. When we get to level 2, boy, we've got to do lots and lots of calculations on that. But for now, just remember the definition of those two, because that's what the LOS asks you to do. Describe defined contribution and defined benefits. So we're just describing them. And remember who bears the risk. Here's one of my favorite LOSs. Describe the steps in the portfolio management process. All right, so what do? We've got some planning, we've got some execution, and we have some feedback. So think about this in the big picture. What we're going to do is we're going to just meet with our client, try to figure stuff out, and then we're going to execute some trades so that the portfolio can satisfy the client's needs. And then over time, we're going to look back and say, geez, how did we do? Did we meet the client's needs? Did we beat a benchmark? And then we're going to complete the cycle. So we do the planning, the executing, and the feedback. And then we're going to repeat this on a regular basis. Maybe that regular basis is annual. All right, so here we go. Describe the steps. So let's start with the planning stage. So understanding the client's needs. So this is going to happen when you first meet the client. Client's going to come to your office and say, this is how much money I have. And he or she's going to put a bunch on the table. Maybe it's couple $1,000, maybe it's a couple $1 million. And the client is going to say, look, I don't know what to do with this money. You do something with it. And so you're going to have to ask the client, all right, what are your financial goals? So we go through all of those things. Maybe it's education planning, maybe it's retirement planning, maybe the client wants to buy a beach house, maybe the client wants to buy a boat. So we're going to try to figure out a financial plan to get the client to meet those objectives. Now, inside of that, there are going to be some constraints. There are going to be liquidity constraints. There are going to be tax constraints and time constraints. There are going to be maybe legal or regulatory constraints and unique circumstance constraints, and there are going to be behavioral constraints. And so I want you to think of these constraints as limiting or restricting factors that tie your hands as the analyst. You know, for example, a client may come to you and say, here's $500,000. This is what I have to invest. But, I want to keep $100,000 for me because I want to be able to go do something else with it. I'm not going to let you have it. So the client has 500, but you only get to invest 400. That would be a liquidity outflow, and that's constraining your ability to put together a meaningful portfolio. All right, so notice what I have over there. It answers the question, what does the client want? And then we're going to prepare this investment policy statement. And this is by far the most fun thing that occurs in the whole CFA program, starting from scratch with a client and then ending at the end when you have developed this portfolio management process and have succeeded in providing the client with what he or she needs. All right, so the IPS is a written document, and I always encourage my fellow analysts to make sure that you are clear in writing all of the background information that's relevant and important, including the investment, the objectives that the client has, both risk and return objectives, and then all of the constraints. What we're going to do is put this relationship in writing so that if there's ever a question, the client calls you in 2 months and says, what about this? You can go back to the policy statement and say, right here in the policy statement, it says something like, if my asset falls by 10% in value, I'm going to rebalance or something like that. So it's in the policy statement, and that helps manage the relationship through the client's life. Now, the risk and return objectives might have and are likely to have a mathematical result. At the end, you might say to the client, all right, you have this amount of money, these are your goals, and these are the constraints. In order for us to get you to where you want to be a year from now, we need to generate a 10% return. And that's going to be a total return that includes, capital gains and dividend income, et cetera, et cetera. We're going to update this regularly, which of course the standard answer regularly means at least yearly, but then of course if ever there's a life-changing event. All right, that completes the planning step. Let's get into the execution step. So think about where we are. We now have a really good knowledge and awareness of who our client is and what his or her needs are. So now we need to take that capital and do something with it. So we're going to do some asset allocation. We're going to do some security analysis. And then we're going to construct the portfolio. So we're going to decide if stocks or bonds or real estate or jewelry or investing in a gold mine or an oil well or movie memorabilia, we're going to figure all that stuff out. Then what we're going to do is analyze each individual asset within a class, security analysis. And so we're going to do a lot of math. We'll probably use some time value of money stuff, maybe the Gordon growth model, maybe the free cash flow model. What we're going to try to do is to find undervalued stocks. We're going to compute the intrinsic value of that stock, probably, maybe even a bond, maybe even a derivative security. And then we're going to buy those stocks and bonds and movie memorabilia that we think are going to appreciate in price or that provide a good income. What we've got to do is make sure that we link the risk and return of each security back to the risk and return objective of the client. And then we're going to construct the portfolio. We're going to diversify. Of course, we're going to diversify, and we're going to diversify across all of those asset classes. And so what example did I give you a few minutes ago? The client comes to us with $500,000. He or she needs the $100,000 for whatever it is. So we have $400,000. So of that $400,000, maybe we'll allocate 5% to cash, maybe 25% to investment grade bonds, maybe 5% to speculative grade bonds, and 40% to equity, et cetera, et cetera. And we'll figure that out. That's the portfolio construction part. Now that completes the execution stage. And then we need to decide, all right, after a week or a month or a year, how well are we doing? So we're going to review it and we're going to monitor it, which means we've got to come up with an adequate benchmark. You know, the standard is to say, oh, my portfolio generated 10% and the S&P 500 index generated only 8%, so I outperformed the index. And that might be a true statement mathematically, but the S&P 500 might not contain any stocks that are in your portfolio. So it's really important to find the appropriate benchmark against which to compare performance. We're going to monitor this regularly, which means we're going to stay in contact with the client. It's really easy just to send a text or an email, every month or every quarter and say, hey, here I am. Here's the results of your performance over the last couple of weeks or month or so. What are you thinking? And then we need to figure out if that performance after some time period has met those client objectives. And we need to put together a report. So that's the feedback stage. All right, how about mutual funds? Mutual funds sound like this. This is the example I always give my students. I'm Jim, and I'm a mutual fund manager, and I say, hey, I'm really smart. Send me your money. I'm going to do something that you guys can't do with it. Now, remember, I'm just speaking in general terms. I'm not speaking in CFA terms. Remember, once you earn the charter and you have those 3 letters after your name, you can't say, hey, I hold the CFA designation. I'm smarter than anybody else. But let's just suppose I'm just a regular Jim. I'm saying, hey, look, I know what to do with your money. Send it to me. And I'll have a prospectus that outlines all of the available all of the available securities that I can invest in. So I'll say, send me your money. I'm going to invest in large cap stocks. Or send me your money. I'm going to invest in small cap stocks. Or send me your money. I'm going to invest in all this stuff. As long as it's in the prospectus, then I'm allowed to make those investments. Of course, I'm going to be compensated for my performance, and I'm going to charge you some fees in there as well. We'll talk about those in another reading. Now, why are mutual funds so popular? And the really easy answer is because they're really easy. You don't have to have $50 million to invest in a mutual fund. Some of the more popular mutual fund manager families will allow you to buy into their fund for as little as $100 if you agree to invest $100, let's say, every month or every paycheck or every quarter. But if you're going to send them a lump sum I think I just set one up for my daughter. I won't tell you who she invested in, but I think she wrote a check for $2,500 was their minimum investment. So they're easy. But why are they so popular? Because of diversification. You get instant diversification, not complete diversification, because you could invest in a mutual fund that mimics the S&P 500 index. That's pretty good diversification. Or you could invest in a mutual fund that only invests in small cap tech stocks that are incorporated in the southern United States. Well, that's not going to be too diversified. It'll be diversified within its asset class, but it's not going to be diversified across all of those asset classes. Plus, you get full-time professional management, and you don't need a lot of money, modest capital investment. Yeah, here's a good question. What's the difference between closed-end and open-end mutual funds? And here's the difference. You ready for this? So what example did I give you a minute ago? I'm Jim, and I have an open-ended mutual fund. Send me your money today. Send it to me tomorrow. Send it to me next week. Whenever you want to send it to me, I'll take it. And by the way, whenever you want some money back, I'll send it back to you. It's open-ended, meaning that cash can flow in and out at any time. On the other hand, a closed-end mutual fund is something that sounds like this. Hey, I'm Jim. Send me your money today, and I'm going to invest it in all these securities. But only send me your money for another month because I'm going to close it. And then once it's closed, you're not going to be able to send me any additional funds, and I'm not going to be able to redeem any of your capital. In fact, the only way you can get your money back is if you go to a secondary market. Now, what happens, the reality of life, is that most closed-end mutual funds were at one time open-ended mutual funds, and then the manager just decided to close it. And so the manager will just tell its shareholders, hey, you got 10 days or 30 days, and then it's going to be closed. And then what happens, that trading then switches over to the New York Stock Exchange or the NASDAQ exchange or some exchange in any country. Now, the value of an open-ended mutual fund is always reported as its net asset value. The value of a closed-end mutual fund is going to be reported as its net asset value, but it's also going to have can I put quotes in here? I don't like doing this, as a stock price. Now, it's not really a stock price, it's a fund price. And that fund share value is probably going to be different than the net asset value. And then open-ended mutual funds generally provide less income versus the closed-end mutual fund. A couple of different types of mutual funds. There are money market mutual funds. This is probably what you'll do in crafting a policy statement when a client wants, let's say, 5% in cash. You're not, of course, going to have cash laying around. You're probably not going to just go put it into a bank because that interest rate, at least today, is pretty close to zero. You probably open a money market mutual fund, which is what I have done. And I have access to that capital on a daily basis. You can even get them where they have debit cards, et cetera, et cetera. Money market mutual funds also always have a net asset value of $1. That's just the way that they are constructed. And they were originally constructed like that so that the money market mutual fund industry could say, hey, look, this is what you're getting compared to a savings account or a checking account, and we offer more interest. Bond mutual funds invest in individual bonds. Stock mutual funds invest in individual stocks. And both bond funds and stock funds, they can be passively managed or actively managed. And there's going to be so many cool things that we talk about, primarily when we get to level 3, about active management and passive management. There's, you think of investing in a fund that mimics the S&P 500 index is really easy, but it can be very easy. But of course, as a fund manager, you're trying to add value. There's so many cool things that you can do to add value. We'll do all that at level 3. And then there are hybrid or balanced funds that invest in both kinds of assets. Exchange traded funds, these are really popular and they compete with mutual funds. It is generally thought of as an index fund, but it trades on an exchange. And the interesting thing about these exchange traded funds is that there's so many of them that they can really be tailored to mimic the performance of individual sectors or even baskets of stocks. And so, I mean, of course, there are ETFs that mimic the S&P 500 index. Those are called the spiders, but there are bunches of ETFs that give you specific exposure to whatever factor that you want. Once again, we'll talk about factor analysis. I think that's all the way at level 3. Here's a table of the biggest exchange-traded funds. Notice over there on the far right column, $254 billion in spiders. How about hedge funds? Hedge funds is a really cool animal. Think about this. If I'm Jim and if I'm opening a hedge fund, I'm going to say the following. I'm going to say, send me your money. Now, the thing about the hedge fund, I'm not going to let you get away with sending me just $2,500. I need a bigger commitment. I'm going to say, you need to send me $500,000 or $1 million or even $5 million. So send me your money today. And by the way, I'm not going to give it back to you for, maybe a year, maybe 2 years. So there are big differences between hedge funds and mutual funds in terms of the mechanics and the requirements. But the biggest difference is that if I'm Jim and I'm a hedge fund manager, I'm going to say, send me your money, and I'm going to do anything I want with it. And so essentially what you're saying is, all right, I trust you, Jim. Go ahead and do whatever you want. So I'm going to invest in all different sorts of crazy things. I'm going to buy swap contracts. I'm going to buy futures contracts. I'm going to short sell. I'm going to do pairs trading. I'm going to do all kinds of stuff. And essentially what I'm trying to do is I'm trying to outperform on a risk-adjusted basis anybody else that's out there managing money. And so notice the final check mark there is that hedge funds are known for using leverage. So that's using other people's money. And that takes us through the overview. I really tried to give you kind of a big picture sense of what's going to happen in the next few readings.